So Brian is a investment advisor, has been for roughly 25 years. He lives in the wonderful state of Utah. I had to come up with an adjective for Utah. Every time I've been to Utah, it's either been freezing cold or hotter than all heck. So I'm sure there are people that live there on purpose that love that temperatures, but that's great. One of the things that is not on here is that he was also picked in a free agency signing by the Philadelphia Eagles, so clearly a small, subtle guy. And we're going to be talking through his methodology. After we go through the methodology, he'll also talk about his results. So it's going to start with why does he have the methodology, then what the methodology is, and then what the methodology produces. So with that, I'd like to turn it over to you, Brian.
Thanks, Matt. I'm going to share my desktop. Our weather today in Utah is probably a little better than what you're seeing back there, Matt.
Yeah, you're right. Well, our weather here stinks also. I have to fully admit. We have either humidity or freezing rain. So.
You seeing my screen?
Yes, we are.
Okay. Gone over that. I have to go over a few disclosures, and Matt, thank you for having me today. I really appreciate the opportunity, and I hope that the time we spend together is valuable for those of you that you're attending, and appreciate the opportunity. Just a couple disclosures that I need to go over. The first one is that Matt just had mentioned that investing involves risk. You can lose money, as we all know, and I'm going to show some numbers at the end of this presentation that talk about investment returns. And these returns have been adjusted to include the cost of transactions, commissions, reinvestment of dividends and capital gains, and when applicable, the investment advisory fee. And then the last thing is, as you have all heard before, these figures that we'll show represent past performance, and of course, there's no guarantee of future results. So today we're going to talk about a few things, and I'm excited about it. The first thing we're going to talk about is the value of value investing. You know, why am I a value investor? Why did I choose to go this direction with my investment philosophy? Then we're going to talk about how I do it, my methodology. At the end, you'll see our track record, and we can discuss that and talk about that. And then we'll open it up for some questions at the end. I'll turn it back to Matt, and he'll kind of lead those questions. And in fact, I'm going to pause after each section and open it up for questions and let Matt direct those questions to me. So this first chart here, back to why I'm a value investor. And this chart really illustrates what got me attracted to value investing. Let me just describe the chart a little bit. This is a chart that shows $1 invested in 4 different portfolios: small cap value, large cap value, small cap growth, and large cap growth. From 1970, $1 invested into small cap value had grown to an amazing $352. It's just an incredible return. That's a 14.6% return over that time frame. Its peer, small cap growth, had grown to an annual return of 8.7% and $36. If you add a 0 to that 36, you're about the same price as the $352. The value outperformed significantly. This is a huge, huge difference. And by the way, this chart is a log scale, and if we were to see these numbers, these lines near the bottom, these 3 lines here, the large cap growth, the small cap growth, they would be near the bottom. This is a huge outperformance by small cap value. And then we can see this difference here, $36 to $352. And then we look at the large cap, or the small cap, or excuse me, large cap value, and yeah, almost tenfold there. And then if we look at large cap growth, $68, $1 grew, and compared to large cap growth, $24. So there's a big outperformance, value versus growth. This next chart really illustrates and reemphasizes why why I'm a value investor. And it's some of the same data, but just shown a little differently. The blue bars are value portfolios, small value, mid value, and large value. And the white line between each one of these bars is the annual return, the compounded annual returns. And the top line is the 1-year best return, and down at the bottom, the 1-year worst return, the lowest return. And we can see that in every case, large cap value, mid cap value, and small cap value outperformed its peer significantly. And we really get better returns. And if you look down at the bottom, we get less volatility. I think we all would agree that we would love to have better returns and less volatility.
Just to step in here real quick, Brian, if you guys remember many weeks ago when we did the return calculations and we did the Sharpe ratio, and if you recall, the Sharpe ratio had the standard deviation of the returns. This is why you would have a much higher Sharpe ratio with the value investing over the over growth investing. When we get to the Siegel book, you're going to understand better why this happens. But what matters for now is that it does, and these numbers are, Brian, I think these numbers are from 1970 through 2012, so over 42 years. It's a pretty good size time frame.
Exactly. Thanks, Matt. So here's a picture of Warren Buffett, and the other guy there is a picture of me. This is a few years ago, and I'll talk about when and where that picture was taken in a minute. But I want to talk a little bit about my journey as an investor and also investment advisor. And in 1989, I was just released by the Philadelphia Eagles organization. And my dream of being in the NFL Hall of Fame was fading real quickly. I was out looking for a job, and soon after, I was hired as a broker with a local brokerage firm here in Salt Lake, regional brokerage firm that had a headquarters in Denver, Colorado. And my first day on the job, my manager told me, he said, Brian, you need to take this Series 7 exam, and if you don't pass that exam, you're fired. I was very motivated to study for that exam, and glad to say that I did well on that on the Series 7 and passed it. Soon after that, I was sent to Denver for training, and I thought I was going to get some training on how to invest and how to identify good securities and good investments. But really, the whole time in Denver was spent learning how to sell securities, how to be a good salesman. We practice cold calling, and there's nothing I hate worse than getting a cold call, but I even hate making a cold call even worse. And I really didn't have any really guidance as far as how to be a good investor. The company I worked for, they had a research team. They gave us research. We were supposed to read the research and really disseminate this information to our customers. I really wanted to learn how to be a good investor. That's what intrigued me to the industry in the first place. I had finance classes in college. I have a degree in finance and economics, and it was something that I had a big interest in. Well, for the first few years, I didn't have any direction. My first and only customer at the time was my dad. He felt sorry for me, opened an account with me, and he said he was reading a book by William O'Neill titled How to Make Money in Stocks. And I read that book, and I loved it. It gave me some direction. It gave me some guidance. I had a system that I could use, which was much better than no system at all. I really got into it. I subscribed to the Investor Business Daily newspaper, which William O'Neill was the publisher. We subscribed to his weekly charts, and every week we'd get his charts, and myself and a few other brokers in our office would go through these charts religiously, identifying companies that met the CAN-SLIM methodology. We really got into it, and I thought it was a great system. It gave me some direction. Well, in 1993, a broker I was working with asked me if I had read the Berkshire Hathaway annual report. And I said, no, I hadn't. And he says, you ought to read it. You should especially read the chairman's letter. And so I took it home that weekend, and I still remember this. This has been over 20 years ago. I read that letter, and it was as if my eyes were open for the first time concerning business and investing. I don't think I really understood it. Even though I had a finance degree and an economics degree, I don't really think I understood the concept of investing like I did after I read that annual report. It really struck me. It was a really interesting period in my life, and I determined at that point that I was going to read everything I could find on Warren Buffett. I read every annual report going back to 1977 through the present. In fact, this past weekend, I spent some time reading the Berkshire Hathaway annual report, or at least the chairman's letter this past weekend, and always a lot of good information. He's a very good writer, and so I spent the next few years just reading everything I could, books on Warren Buffett, books about how he did it, and spent a lot of time doing a lot of research about him, trying to understand his methodology. In about 2001 or 2002, I decided I wanted to go to the Berkshire Hathaway annual meeting, and this picture was taken in 2001 or 2002 at a Berkshire Hathaway annual meeting in Omaha. And I went 6 or 7 times over the next few years, and it was a great experience. I really enjoyed it, and it's a lot of fun. If any of you ever have a chance to go to Omaha, it's a lot of fun, and I learned a lot from Mr. Warren Buffett, and so my approach and my strategy was really based on reading that first annual report in 1993, and then learning about the value approach. And so I'm going to talk about that a little bit. Here's a picture of, many of you recognize Babe Ruth here. And I'd like to make an analogy between baseball and investing. In baseball, you have, if you're up at bat, you have 3 pitches or 3 strikes and you're out. And if you're up at bat and you have 2 strikes against you, and the next pitch coming your way is anywhere near the strike zone, you really are forced to swing at that pitch. Well, in investing, we see investment pitches come our way all the time. But the difference is we have no called strikes against us. We can sit and watch and wait for our perfect pitch. We don't have to swing at strikes or what someone else might call a strike or a fat pitch. We can sit and watch for that perfect pitch. And so I want to talk about waiting for our pitch and my 4-step process identifying the right pitch for the type of investments we want to invest in. It's a 4-step process, and it's a process where we filter out companies as we go through them using this process. The first thing we look at is identifying sectors and industries and companies we understand. The first rule of investing is don't invest in anything you don't understand. Well, that's our first rule, is don't get involved or spend time investing in something that we don't understand or we can't grasp. Some businesses are just really difficult to understand. The second process, and if we can't understand it, we let that pitch go right on by. We don't even waste any time. We just let it go by. The second step in our four-step process is a long-term competitive advantage. If we see a company that we understand, but we don't see a competitive advantage that this company might have over competitors, we let the pitch go on by. The third step is identifying excellent management. And we have a process that we go through to identify excellent management. Again, we need all three of these for our perfect pitch. And then the last thing that we look at is identifying a good price to buy this company and buying it at a discount to its intrinsic value. And that's what we're trying to do, is identify good companies selling below their intrinsic value. Warren Buffett said the key to successful investing is to purchase shares in good businesses when market prices were at large discount from underlying business values. And that's really the process of what we're trying to do, identify good companies selling below intrinsic value. And we'll define intrinsic value as we go on.
Brian, let me do a quick interrupt. When you're using value and growth, large cap, small cap, are you using the Morningstar definitions of that?
I would say that we don't have hard and fast rules on value and growth. We sometimes will identify what some people call a growth stock as representing good value. Some people might say this is a growth stock, but we might find that growth stock is selling at a discount to intrinsic value. But I do understand what in Morningstar, they typically have criteria where they call it, this is a growth stock and this is a value stock. But we are trying to identify companies, whether they're a growth stock in the Morningstar category or they're a value stock. We're trying to identify companies that represent value. And they might be a growth stock in Morningstar, it might be a value stock, but we're trying to buy companies that represent value. I would say more often than not, these value stocks would probably fall in the category of in Morningstar's value portfolio.
Okay, great.
Or index. So here we see a blue circle, and in this circle this represents everything we understand and know about investing in business. Outside the circle, we don't understand. It's outside our circle of understanding. And what's important is to know your boundaries of your own circle of understanding and stay within it. I think that's a real fundamental concept no matter what investment strategy you use. If you know what your boundaries are and you stay inside those boundaries, you're going to be a lot more successful. If you get outside of what you understand, that's where you're going to find yourself in trouble. So again, number one point is we're talking about the industries and sectors and businesses we understand. That's our number one rule. What kind of sectors and industries do we understand? Here's consumer products. I think a lot of people, all of us are consumers. A lot of people can identify and understand consumer products. That's probably an easy one for most people. Media, same thing. Media companies. A lot of us like to watch movies, watch TV, read magazines, the newspaper. A lot of us can identify with those type of companies. Same thing with retail. These are easy. I think a lot of people can identify and understand some stocks, some companies in these sectors. Utilities. We all use utilities every day. A lot of utilities operate in either a monopoly market where they are the only provider of a service, or maybe there's just one or two, a duopoly, one or two companies. Fairly easy businesses to understand from a competitive standpoint. Medical. These are examples of some industries and sectors where we would understand a lot of the companies in those sectors. It doesn't mean that we would understand every one, but we understand a lot of them. I'd like to tell just a quick story. My wife is a retired flight attendant for one of the major airlines. She worked for 20 years, traveled a lot, and one trip she came back and told me about this company she visited. In fact, I think, Matt, it was in Washington, D.C. or near Washington, D.C. It's a company called TJ Maxx, I believe. It was TJ Maxx. It might have been a division of TJ Maxx. But she told me about this company, and she just thought it was just the neatest store and concept. And we didn't have those out in Utah, I think, at the time. And I ignored her. And over the years, I've watched TJ Maxx, and it's just been an incredible company and a great concept. And really missed out in not listening to my wife. And just one of those experiences where it really pays to listen to your wife, all you husbands out there, and especially in sectors and industries where they might have an edge. My wife, I think, had a little edge there and understood something that I didn't. But you can learn a lot of things from other people and talk to other people about different industries and sectors. Some of the sectors that we don't understand and we struggle with, some technology companies, some companies in biotech, commodities, natural resources. And I think one of the reasons, the common themes of these companies where I struggle maybe understanding is it's hard for me to identify a competitive advantage with a lot of these companies in these sectors. But there's some crossover. For example, Netflix. Some people call Netflix a technology company. Well, it also could be called a media company. So it kind of crosses over. To me, Netflix is a lot easier to understand than some of the technology hardware companies out there. So not every company in every sector, but we don't understand, but we feel like the majority or a lot of companies in these sectors are difficult to understand, or at least difficult to understand from the sense that we can't identify a competitive advantage in a lot of these sectors. Here's a brand name, a logo that a lot of you would identify with, or a lot of you have seen. And in fact, talking about sectors and industries we understand, our first point, this logo is recognized by 94% of the world's population. It's sold in over 200 countries, a 43% market share in the U.S., and this is the most amazing thing, I think, is 1.7 billion servings are consumed every day of Coca-Cola products. It's pretty incredible. And around the world, the average person consumes a Coke product every 4 days. I think, a lot of us can identify with a company like that. It's something that's well known. It's a strong brand. And I saw a comment about soda Kodak, and I would argue that Kodak is a company that it was based on technology, and the technology technology advancements really put Kodak out of business. Coca-Cola is not a technology company, and it's a brand, and it's a soft drink. It's not really going to be threatened by technology, at least from my perspective. One thing a point I'd like to make is, if you were to try to compete with Coca-Cola, how much money would it take to develop a brand, the kind of strength that Coca-Cola has today? It would take a lot of money and a lot of effort, and I think it would take decades to develop a brand recognition like Coca-Cola. It's a very powerful, very valuable brand. And that's, again, just an example of a company that we feel like we can understand. So, Matt, do we have any questions on that? That really wraps up our point on number one about understanding good businesses and industries we understand.
Yeah, there's the only question so far, and you may want to do this when you talk about the methodology or some examples of doing the work, is a question around SodaStream and whether or not SodaStream could put Coke out of business.
Yeah, I don't know. I mean, I'm not familiar with SodaStream. I do know that that just maybe that says a lot right there. SodaStream is probably not as recognized, their brand, their product, like a Coca-Cola. But so I don't know that I could say yes or no on that. I don't really know SodaStream. So
Okay, let's move on.
okay. So here we have a picture, and we're going to talk about the second concept of a long-term competitive advantage. We have a picture here of a castle with a moat, water around this castle. And castles and moats were built in medieval times to fortify and keep the bad guy out, to keep people that they wanted out, to keep them out of their castle. And in business, we want to identify companies that have, and this is a quote by Warren Buffett, in business I look for economic castles protected by unbreachable moats. And I think that a company that has a competitive advantage, it's a great example. This is a great example of showing a great example of a competitive moat. And I enjoy finding companies that have a competitive moat, a competitive advantage. And the job of the business owner, or the business management team, is to widen that competitive advantage. And this is what's really exciting to me, is to find companies that have a competitive advantage, to identify those companies and what makes them, and what gives them their advantage. And next we're going to talk about what kind of competitive advantages do we see in the marketplace? How do we identify competitive advantages? One of the competitive advantages that we recognize is brand name recognition. And I'd like to play a little game here, the word game, and see what you guys come up with. If I mention coffee, what's the first thing that comes to your mind? Okay, I just saw Starbucks, the first one I saw. I think a lot of you would mention Starbucks as a company that's identified with coffee. Starbucks has a great brand recognition associated with coffee. When I mention or name five of the top luxury automobile brands, who would they be? Okay, first one I saw was Mercedes. Again, both of those are great brands. A lot of value identified with those brands. The next competitive advantage that we identify is low-cost provider. In the United States, the steel industry has been a very difficult.
So I could just schedule an appointment with Christian Batista?
It's been very difficult for the steel industry. But there's a company in the U.S. that's thrived for a long time, a U.S. company, and they've really created a low-cost advantage. And Nucor Steel has been a company that's thrived in a very difficult industry because they have created a low-cost advantage. Back to the name game. If I mention low prices, what do you think of? What comes to your mind? Yeah, exactly, Walmart. Again, Walmart really has a low-cost advantage. They also have brand name recognition. They have some other advantages such as distribution, scale. So Walmart has a lot of advantages, competitive advantages. Another area that we like to identify as competitive advantage is barriers to entry. Some of those barriers to entry are because of rules and regulations, laws, Talk about the utility industry, regulated utility industry, and a company like Southern California Edison, who operates in a monopoly or a duopoly situation. Most utilities do. You just don't wake up one morning and say, I'm going to start a utility company. It's very regulated and very difficult to get into, huge barriers to entry. Another industry that's very difficult to get into, high barriers to entry because of huge capital expenditures, huge capital costs, investments, is the commercial aerospace business. If you think of who competes with Boeing, there's really one big major player, and that's Airbus. So we have Boeing and Airbus operating really in a duopoly situation. And I think that gives Boeing a competitive advantage as opposed to having dozens of competitors in that space.
Brian,
So
Brian, hang on 1 second if you could. I just want to do a time check here. We're about 40 minutes in, and we're much less than a third of the way. So if you want to get out on the time schedule that you had said, we probably need to pick it up a little bit.
Okay, I'll pick it up. Then we have the networking effect. Visa is in the industry of providing credit and payment systems for people, and the people carry Visa in their wallets. Why? Because retailers accept Visa, and that they really work off each other. That's a networking effect. And then a company like eBay, same thing. Buyers go to eBay because that's where products they want to buy, and sellers list their products on eBay because that's where buyers are. So it's really a networking effect. There's several other different types of competitive advantages, but these are 4 competitive advantages that we identify with and that we recognize. Matt, any questions about long-term competitive advantages?
Nope, nothing on this. And I think you can probably summarize. We all recognize excellent management. This is back to the Brandeis quote about pornography, I think, here. So if you could move forward, that'd be great.
Okay. So number 3, excellent management. This is our third criteria, and we look for 5 different traits for excellent management. And the first one is intelligence. Some of these are somewhat subjective. I've never seen anybody, an IQ test of a management team. But we look for companies that display or show intelligence in their actions, what they've been doing for shareholders. Energy. If you find people with intelligence and energy, you find a lot of success. And the third one is honesty. You want to have companies that are honest, they're straightforward, they're transparent. The fourth one is shareholder friendly. They do things that create value, intrinsic value over time. And stock ownership. It's important that we are partners with the management team. They have a vested interest in the company and its well-being and its intrinsic value, growing intrinsic value. We feel like if you have all of these 5 things, that's a recipe for success. So we really like excellent management. How do you find, some of these are subjective, and we do a lot of research, reading, trying to listen to conference calls, listening to management, look at their track record, their past performance, try to judge whether or not they have these characteristics. Here's an example of a company called Fastenal. They're a wholesale industrial construction supply company, and we feel like they really represent those 5 traits. They're smart, energetic, honest. They're definitely shareholder friendly. They have substantial portion of ownership of their own net worth in the company, and their performance has been incredible. 18% earnings per share growth, 10-year dividend growth. Return on equity is very, very strong. No long-term debt. I mean, very, very solid performance. And the 2 areas that were hit the hardest during this last economic downturn was financials and construction-related housing, commercial construction-related companies. And they were in that industry. And they were able to grow every year during that time. In 2009, they had earned down a down year. Earnings were down, but they were still profitable, and they've continued to grow since then. It's just an excellent company. We feel like they represent those qualities we talked about in excellent management. Any questions on that about excellent management, Matt?
Just, excuse me, a comment that some of these traits are measurable, but you can't measure some of the things, just as you said at the beginning about honesty and et cetera. So I think you had talked about transparency and listening to calls and making sure that people were addressing the concerns, et cetera. So, just any comments you might have about the honesty and integrity question or point.
Yeah, so it's like you said, it's subjective, and I think you have to look at track record, history. We try to do a lot of research on the management team and their reputation, and so it's subjective. It's just like when you meet somebody. We're always trying to identify characteristics when you first meet somebody. Yeah, I think that guy's. So there is some subjectivity to this, but we also we want management team that has a track record. We don't want a management team that has a criminal track record, obviously. So that's part of that process, is doing our research and finding out the background of management team and their history and their decision-making over a long period of time.
Okay. One of the other questions, and you may want to do this after Section 4, but it's up to you. How long does it take you to analyze a company, both all four steps, basically, for from idea through selecting a value you're willing to buy the stock at?
I don't know if there's one hard and fast answer. Sometimes it takes, I'll research a company for weeks, maybe months. I'll come back to it. Maybe the price wasn't right, and I'll come back to it. Really the first three of our criteria of the four, a company we understand, a competitive advantage, excellent management. If it has those three, we'll put it on the watch list. And if the price isn't right, we'll put it on the watch list, kind of our wish list, and wait, and hopefully maybe at some point there'll be a price opportunity. But I don't know if there's really one hard and fast. I know answer to that question. We look at companies, and sometimes we can make a pretty quick analysis, and it might be just a few weeks. Sometimes it may take longer. And that doesn't mean we're only researching that particular company during that time, but sometimes it just takes longer to understand and get your head around it.
Okay.
Okay, number 4, this is our last criteria. And like I said, the first three, if we have the first three, we might wait for the price. And that's buying a company at a good price. We're talking about price, and some of you might believe that markets are efficient and that stock prices are fairly valued at all times. I don't really believe that. I think over the short term, prices can be wildly volatile, and that creates opportunities for the investor. Over the long term, I do believe that prices represent intrinsic value, represent fair value over time. But here's a quote by Warren Buffett that I really like. It says, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And that really just says that in the short run, it's a popularity contest. But in the long run, it's really a weighing machine. It's trying to weigh value. And I really believe that. He also says the speed at which a business success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate. And if you think about that, if the company is growing its intrinsic value each and every year, that discount to intrinsic value, or that value is growing each year, the price that you paid may not be recognized, or the value that you put on this stock may not be recognized immediately. But as long as this company is growing intrinsic value, in the end, you'll probably turn out, the investment will turn out to be a pretty good investment. And then the last thing he says, in fact, a delayed recognition can be advantage. It may give us a chance to buy more of a good thing at a bargain price.
Yeah, I'd like to do a quick stop here. There's been a lot of discussion in our group Brian, about exactly where you started this with the perfect, is the market efficient, et cetera. And one of the things that we've been talking about is that it may be efficient over long periods of time and inefficient over short periods of time. Is that a summary of what you're trying to say, or what
Exactly,
Warren is
yeah.
saying here?
It's exactly what I'm trying to say. I think in the short run, stocks get mispriced all the time, day to day, month to month, week to week. But over the long run, I think stocks really do follow intrinsic value. Now, there might be several years before that intrinsic value is recognized. But eventually, if the company is growing intrinsic value, that's the key. Everybody's heard of value traps. You might buy a company and you think this is a great value, but if intrinsic value is not growing, it may never turn out to be a good investment. The longer you own it, that becomes a problem if intrinsic value it doesn't continue to grow each and every year. So that's key, I think, if you're buying a company and the market's not recognizing its intrinsic value, not recognizing its true or fair value, and if it's declining, you might get into trouble eventually the longer you own it. But if you own a company that's growing intrinsic value year in and year out, I think that's really a safeguard for you.
Okay, that's great. There's a couple questions that I have a concern that it might be a compliance issue, but I'm going to put it out there and you can decide whether you can answer it, because it's all up to you. Are you saying from your example earlier that Fastenal is an example where the intrinsic value is not recognized?
Oh, no. I think intrinsic value is recognized in Fastenal. We were talking about Fastenal is really part of our excellent management, the definition of good quality management. Fastenal is a company, extremely high-performing company, and the market does recognize that its value, and I would say, in fact, it's Fastenal. Again, this is not a recommendation, but in my opinion, Fastenal is selling at or near fair value. It does not look like a great buy today to me, but it's a great company. It's on my wish list. I'd love it if it dropped, 50, 30% or something like that. So, yeah, we love Fastenal, but I think its value is largely recognized in its current price, intrinsic value. So let's talk a little bit. Let's go on to the next thing. That was a quote by Warren Buffett, 1987 shareholder letter. Let's continue on our fourth concept, and that's intrinsic value. What is intrinsic value in the definition? And we want to buy at a discount to that value. And really, the definition is the sum of all future cash flows discounted back at a proper rate. And so the difficulty, and that's also known as the discounted cash flow model. Those of you that had finance or finance classes, you might remember this, a DCF or discounted cash flow model. And really what that does is you take all future cash flows of an income stream and you discount it at a certain discount, the discount rate, and that's used in real estate, the discount rate. You can also use that in valuing an income stream, and back to the present value, back to today's value. And that's the idea of intrinsic value. And so we're trying to buy and identify companies selling below their intrinsic value. How do I do this? I do this a little differently than the DCF model, the discounted cash flow model. I found a system that I've worked on over the years and perfected, and something that works for me. And some of the things that I look at to calculate that is, number one, is income statement. We look at the net income, revenue, and profit growth. We look at the balance sheet. We look at different calculations on the balance sheet, debt to equity, return on equity, return on assets, the cash flow statement, and adjustments to net income and capital expenditures. And then we try to identify cash earnings or owner earnings. And what is that? What's the difference between cash earnings and reported earnings and GAAP earnings? And then estimate growth rates. That's something we try to do. And then we estimate a multiple of those cash earnings. Now, what are investors going to pay for that? Or what's the right price for those earnings in the future, based on all the things we talked about: competitive advantage, brand recognition, business we understand, and so on, management team. And once we put all these inputs in our formula, in our model, we come up with a 5-year annual return, a projected return. And now I'm going to go on and kind of talk about what we look at on the income statement. So here's an income statement of Fastenal. And again, we're not recommending Fastenal. I don't own Fastenal, by the way. It's not in our portfolio, but I do think I admire it. It's a great company. But here's a company that in 2010 had $2.2 billion in revenue, 2011, 2.7, and 2012, 3.1 billion, had revenue growth of 17.5%. So the company is really growing really at a healthy clip. Down here, net earnings, a growth rate of 25.9%, and then earnings per share of 25.6%. So really solid performance by a great company. Here we take net income divided by number of shares, and we come up with this number right here, $1.42 earnings per share. So those are some of the things and metrics we look at on the income statement. Any questions on that, Matt?
Sorry, I was just going to make a quick point here. A lot of people that have been trying to go from doing the technical analysis, which was kind of what Warren's first point was on slide 18, the short run, market's a voting machine, moving into fundamental analysis. InvestTools has some quickie analysis, like looking at phase 2 scores. They have FE scores. They have some other things where they try and score this, but it's kind of a black box, and it's also not nearly to this level of depth. It's better than not doing anything. Trefis is probably the next step for those of you that are familiar with Trefis. And then what Brian is talking about, and the reason I've got Brian here is his level is a step beyond that. And you're going to see why moving from 3 green arrows to phase 2 to Trefis to something beyond Trefis can pay off a heck of a lot more.
So, thank you, Matt. So the next statement we analyze is the balance sheet. And again, this is Fastenal. This is 2012. And there's 3 sections to the balance sheet. We have the assets here at the top. We have liabilities here in the middle and stockholders' equity. And then down here at the bottom, we have just stockholders' equity. And we look at all 3 of these different sectors and sections. And here at the top, we have total assets. That's property, plant, and equipment. That's cash on the balance sheet, inventories, and we come up with a total assets of $1.8 billion. We take this liabilities of $204 million, and we subtract that from the assets, and we come up with this number down here, stockholders' equity. Stockholder equity is known by a number of different names: book value, shareholder equity, net worth. All of those things describe stockholder equity. A lot of people use the term book value. If you were to take all of the assets of the company, pay off all the liabilities, what's left over to the shareholders is this number right here, stockholders' equity. Some of the calculations we use using some of these numbers is we take the net income from the income statement, we divide that by the assets right here, $1.8 billion, and we come up with the return on assets, our ROA, of 23%. I'll talk a little bit more about that in a second, what that means. Debt to equity. Well, Fastenal doesn't have any long-term debt. And typically when you calculate long-term debt to equity, you look at long-term debt for that calculation. Because they don't have any long-term debt, this calculation does not really mean anything. They do have a small amount of current liabilities. These are accounts payable and accrued expenses, but really no long-term debt. So they have a really strong position, their balance sheet. And then the last calculation, or one of the calculations we look at, is return on equity. Net income divided by shareholders' equity. This number down here at the bottom, the $1.5 billion. And that's a 27% return on equity. What does that mean? And is that good or is that bad? These are incredibly good numbers. What that means to me is if you had a huge amounts of capital that you could throw at this business, and they could go out and build more stores, get more trucks, and you could still get that 23% return on assets on your money, that is a very healthy business. they're not using any or very little leverage. They could actually, increase their leverage and increase the return on equity a little. The only difference between these two numbers, the return on assets and return on equity, is just leverage right here. This $204 million is really the difference between these two calculations. By adding a little leverage, they could probably juice up the return on equity even higher and get really high returns on their equity. That's the net worth of the company, the money that shareholders have invested in this company. And so these numbers really mean that this company is generating very high returns on its assets, on its net equity, or on its book value. Any questions on that, Matt?
Yes, I think one of the one common thread question here is, do you do this analysis within each of the industries? Because clearly a utility, for example, as one of the questions points out, is going to have a much higher debt-to-equity ratio than someone like Fastenal. Retailer might be somewhere in between. So are you comparing these to its cohorts? Are you comparing this to a generic good, or how do you look at that?
Yeah, you really need to stay within the industry compared to peers in their industry. Different industries have different characteristics. An industry that has very consistent cash flow, like a utility, you could argue, and I think the argument can be made, that they can take on more debt because of that consistent cash flow. Or a business that's in a very volatile industry, you see a lot of technology companies with little or no debt. Well, the reason why is because their business can be very volatile, and if they have a lot of debt during a downturn, that can put them out of business. And so a lot of debt in some industries are okay, and debt in other industries are not. I think a company like Fastenal could, you could argue that they might be able to take on a little bit more debt than what they have, but I'm not complaining. I'd love a company to get 23% return on, a 27% return on equity with very little debt. That's a really high-quality company. And it really speaks, if you really go back to the assets, return on assets, that's a huge number for any company, those kind of returns on assets.
Great. Thanks.
So the next section is our cash flow statement, which we look at. And this is my favorite one. I really feel like I can get an understanding of cash earnings. And why are we interested in cash earnings? I mean, if cash is really what the company has to operate with. We have reported earnings, and I'm not discounting reported earnings and saying they're not something that's of value. I absolutely think that. And I think a lot of times companies rely on adjusted earnings and trying to mask what the problems inside the company. But we love cash, and cash is really what a company can spend at the end of the day. And they can make investments with that cash. They can pay dividends with that cash. They can buy back stock. They can invest in new businesses and operations that grow the company. So we really value the cash earnings of the company. And so we try to identify discrepancies between reported earnings and cash earnings and try to make an analysis in that regard. So we're looking for cash earnings. And to do that, the first line is net earnings, and that comes directly from the income statement right there, $420 million. And there's, before I get to that, there's three main sections of the cash flow statement. You have cash flows from operating activities, cash from investing activities, and then you have cash from financing activities. So operating activities is just that. That's just the cash from operations and then adjustments to those cash, non-cash charges. Then here you have in the second section investing activities. This is where a company might invest in property, plant, and equipment. They might sell some property and equipment. And then down here, the cash flows from financing activities. They might be buying back stock, paying off debt, issuing debt. These are financing activities of the corporation. But this really tells you where the cash is going. The first number we look at is the net earnings, and then the adjustments to that. And what we do is we add back depreciation and amortization. That is really a non-cash charge. And so that masks the cash that's coming into the company. And then we add back amortization. And then the last calculation we use is we subtract from those three numbers, we subtract the purchase of property, plant, and equipment or capital expenditures. but we find that we need to make a different adjustment to this this capital expenditure number here. We want to find or identify what we call maintenance capital expenditures to maintain the current business, because to grow the business, that's a discretionary decision to spend that cash by management. We want to know what the current earnings, or the cash earnings of the current business as it is, and try to identify that number. And we have to go to the annual report, the 10K, to find and look at the financial notes of the 10K to really find out and identify the difference between maintenance capital expenditures and capital expenditures to grow the business. And after looking through the annual report and knowing a little bit about Fastenal and doing some research on Fastenal, I'm not an expert on Fastenal. I don't own the stock. But I have identified 3 lines that really, I think, are maintenance capital expenditures. And it's these 3 lines here: data processing software, real estate improvements, and vehicle purchases. And if I add those 3 up, we have a $28 million in capital expenditures, maintenance capital expenditures. So we take all this information that we have here that we've gone over to really identify owner earnings or cash earnings. Net income of $420 million, that's from the income statement. We add back depreciation and amortization. Those are non-cash charges from our cash flow statement. And then we take out or minus capital expenditures, and we come up with cash earnings of $446 million. We divide that by the current number of shares, and that's on the income statement, and we get cash earnings of $1.50. The difference, reported earnings, Fastenal reported $1.42 for 2012, so it's about an 8-cent difference, an increase in cash earnings. And so that's the number we plug into our model, and we make adjustments, some assumptions on how fast those cash earnings are going to grow. And that takes me to the next section. So Matt, before I move on, are there any questions on that?
Yeah, I think your next. So a couple of the questions are on the how do you take the history and make projections. So that's one part. I think one comment on what you've just done is interesting numbers that came out on Friday is that we have 97% of the S&P 500 have reported. 71% beat their earnings expectations, 63% beat on revenues. That sounds great, but the other way of reading that is that for all of the analysts that are following it and doing the work themselves, 71% were wrong on earnings and 2/3 were wrong on revenues. So I think there's lots and lots of talk about beating, and that comes back to that short-term focus on companies rising and falling within a couple days of earnings, but it's not necessarily based on any kind of reality. It's based on people's inability to make projections. And when I look at the numbers every single quarter, the number of beats and the number of fails is so high that that I'm not sure that that looking at the market's version of those numbers matters as much. So I'd love to see how you guys are making that projection.
Yeah, and so we appreciate those comments. When we look at every quarter and earnings estimates, our decision to buy a company is not really based on one quarter's earnings missed by a penny or a beat by a revenue of $1 million or something, some small amount. It's really not how we make our decision. Again, we're looking long term. We're looking out at least 5 years into the future and trying to determine where this company is going to be 5 years into the future. We're not looking at where earnings are going to be this next quarter, whether or not they're going to beat earnings estimates or anything like that. So we're looking at long term. First of all, we look at the industry. Is the industry growing? Is it likely going to continue to grow? Is this company leader in the industry? They have a competitive advantage in that industry. Should they participate in that growth? I mean, these are questions we're asking ourselves. If we're off by a penny on our estimates and that changes our decision on whether we buy the stock or not, we're definitely going down the wrong road. That's not where we want to be. That's not where we, how we analyze a company. I like the quote that Warren Buffett says. He says, "I'd rather be approximately right than precisely wrong." And that's us. We want to have a margin of safety. If we're wrong on our growth projections, we look at a range. We don't have exact numbers and what we think is as far as how fast the company is going to grow. We look at a range of growth projections, maybe a low side, a conservative side, and then we have what we think a probable growth rate is going to be. So we have a range, and the same thing with stocks. We don't know we don't claim to know exactly what intrinsic value of a company is. We think we would have a range of where we think it's at, where we think fair value is, intrinsic value is. If I look at Fastenal, I think it's within fair value, give or take, 5 or 10% on each side, or 10 or 15% on each side. I don't know exactly where exact fair value is, and that's because the future is unknown. But we think some companies are easier to understand and project into the future what sort of revenue and earnings growth. If we can't do that, look out in the future and with a reasonable understanding or a reasonable guess and what the future, what earnings growth and profit growth is going to look like, then obviously it's not a company we're interested in. We have to be able to do that to really make our calculations and really fit our criteria.
That's great. What I'm going to suggest is, first, there was an interesting phrase there. I don't know if everybody caught it, that plus or minus 10%, plus or minus 15% is a normal range. And I know it's some of the things that people have been looking at before. They're trying to pick things to the penny. So just be aware of that huge difference between tactical trading and setting targets versus a value base. We've been going about an hour and 15 minutes. Can I suggest that we take just 5 minutes? That's what we normally do at this point. Take just 5 minutes, come back, look at how to translate all of that work into what is your future projections and then how well this has worked in the past. Is that all right, Brian?
That's great.
Well, welcome back, everybody.
Ready for me?
Brian? Yep. Free to
Okay.
go.
All right, thank you. So just to summarize here, the cash earnings per share, this is a number that we put into our model to calculate intrinsic value. This is the last step of our process of trying to create or determine intrinsic value and trying to buy below intrinsic value. So to go to the next slide, how do we calculate growth rates and future valuations? And I think I talked a little bit about that. We really try to understand the business, industry, where the company has been valued in the past, how the market has valued this company historically. It really boils down to doing your homework. It takes time and effort to understand the business, the industry, and its future prospects. It's about your pitch, finding that right pitch, your perfect pitch. If we really don't understand the business or the industry, we can't understand its future prospects, then we're really not interested in the company. And there's a lot of fish out there in that sea, and we don't have to own this stock or whatever stock that is. We just have to find companies that fall or meet our criteria, our four criteria. And there's a lot of companies out there, and we feel like we can find them over time. So we're going to look for those easy ones that are easy to understand, easy to look forward in our minds to project good, solid industry growth. We think the company might be a leader in that industry. The first thing we do to really understand that is we read. I read a lot. I spend pretty much all day reading annual reports, industry reports, trade publications, papers, magazines. I Google it all the time. If I have a question about a company, I Google it, and there's a lot of good information you can find. I'll Google interview with the CEO or interview with the CFO, and I'll find interviews with CFOs and CEOs that I normally couldn't find. It's not on their website. Well, I listen to conference calls, investor presentations, investor conferences. All those things are available. When I first started in the industry in 1989, in the early 90s, this was not available to your average retail investor or even a an investment advisor like me, unless you're a huge, big organization, these sort of things just weren't available. Today, the playing field has been leveled dramatically. Ask questions. I talk to the company, listen to, again, talk to conference calls. You can ask questions. Competitors, go visit competitors. Talk to customers. Why do they like them? And then we look at history, the numbers, historical growth rates and valuations, and see where the market has valued this company historically. What kind of growth rates has this company grown historically through different economic times, through really good times and through bad times? What have they done? So these are all the sort of subjective things that we look at to try to estimate growth rates and valuations into the future. But it's all about understanding, doing your homework, being selective about those companies that you understand. If you don't, if it's too hard, then you need to have a little folder or a file on your desk that's a too hard file and put it over there. And that's really probably the garbage can. If it's too hard, put it in that file and move on.
I think one point to that, though, is that if it's always too hard, then not doing the work doesn't help you. You can't just say I'm not going to do this at all, but I'm still going to be able to beat the market.
Well, I think what I mean by that is be selective in the companies that you invest in, and you don't have to. There's no reason why you have to own. I'm just throwing a name out here. Well, let's just throw Fastenal. I mean, I don't have to own Fastenal if it doesn't meet all the criteria I'm looking for. If I can't project, maybe it's just too hard to project, and maybe it's unknowable future growth rates of this company or that industry. Well, that's my point. I don't mean that just forget it because the information is easily there, but you're not going to work to get it. I mean, I spend a lot of time and effort trying to understand companies and businesses, industries. What I mean is it's waiting for that right pitch, looking for companies that you can easily, maybe easily is the wrong word, but where you can identify growth rates or make projections into the future. Some companies are just really hard to do that. It may be impossible.
Yeah, and I guess you're being real nice. What I'm saying is if people aren't willing to do work, you can't expect great results without doing some work on something.
Exactly, yeah, you're right. So that's really talking about cash earnings per share. And really, there's a quote by Sir John Templeton, which, he's great investor, and it really just surmises what we're looking for, what we're trying to do, and that is to buy great companies, good companies, at bargain prices. And this whole process, this four-step process, is really identifying that fat pitch, that quality stock is selling at a bargain. And that's what we're trying to do. So here's a company that I've mentioned, Google it. How many times have you guys heard that? How many times have you said that to somebody? Just Google it. And it's in a lot of ways it meets a lot of the criteria that we're talking about. A company with competitive advantage. Their brand really defines internet search. And this is my analysis. This is my opinion. Some of you may have different opinions and analysis of that. They have very good numbers: return on equity, return on assets, revenue growth, a 10-year historical revenue, 40% plus revenue growth, 10-year earnings per share growth of over 56%. In 2012, they had $13 billion in free cash flow. They had debt of $2.9 billion. All these different metrics look pretty attractive. And the thing I thought was interesting about Google, if you look at Google in 2012, was they started showing some cracks. At least their growth rate had started to slow down. And I think what had happened, talking about opportunities, what had happened is the growth investors that loved Google when it was growing at 50% a year, all of a sudden Google wasn't growing at 50. They're growing in the 20s. and they left Google, and the stock price went down. And but value investors are saying, Google, that's a growth stock. They didn't warm up to Google. I think it created an opportunity in 2012 where the stock actually got trading down, and I would say below intrinsic value. It was trading around 16 times earnings in 2012 for a period of time. And of course, now, Google has dramatically increased over the last 2 years. It's up, over 100% or so. And so that just represents a stock that we thought, I wanted to show you an example of a stock that we might look at and say, okay, competitive advantage. It's a company that we understand. I mean, they dominate internet search. They're a leader in an industry. I think they have a competitive advantage. They have a strong balance sheet, income statement. I think the future looks bright for Google. I think they have a long runway ahead as far as growth. They're now getting into mobile search, and they're having some success there, a lot of success there. And we felt, in 2012, it looked like a pretty good opportunity. So I just wanted to show an example of that. I should disclose that I do own Google. This is not a recommendation to buy or sell Google. I want to make that clear. But just something that looked interesting to us in 2012. I wanted to give you an example of that.
And here's an example of a company that some might call a technology company, others might call a consumer good. Doesn't really matter. It's a company you understood, and you can apply the numbers to what they do. So
Yeah.
that seems to be a place where the lines are gray about how you want to define it. That's less important than being able to understand it. Is that fair?
Right. I felt, that's fair enough. I think that's fair. Clearly Google, in the tech, what some people categorize as a technology company. But like I said, there's overlap in every one of those sectors where there's some companies we feel like we understand, probably because I'm a user of Google. I use it every day. I know how it's, and I feel like I understand it. It's really ingrained in our society, particularly users. And I'm sure there's people out there that would have a differing opinion, but this is my opinion. I felt like I understood Google, and it represented an example of what kind of company we're looking for. A company that we looked at and looked interesting in 2012. So let's just briefly talk about our portfolio results. We have two main portfolios, and you got to remember how I do business. I work with individual customers, and they all have individual portfolios with me. I manage individual portfolios with them, and we have two main types of investors, or two sort of strategic goals. We have those that are looking for a balanced approach, a little less volatility, but want growth in their portfolio. And this portfolio had as much as 50% of the portfolio in bonds or fixed income at times over the last 14 years, but varying levels. And then we have another portfolio, which is really an all-stock portfolio, invests primarily in stocks and cash. And here, this strategy, we're trying to identify companies selling below intrinsic value with competitive advantage, just like we talked about our strategy. In both portfolios, the stock portfolios, we're owning the same stocks. Really, the difference is the allocation to bonds and cash. And in both portfolios, you have some cash at times from dividends, for liquidity reasons. And so these are the two main strategies that we have at our firm. And by the way, there's more than one advisor here at my firm. There's two of us. These are portfolios that I manage, not our other advisor. He has his own portfolios that he manages. And the way that these numbers have been put together, there are two portfolios, and it's really, these numbers are calculated on the sum of all the accounts combined into one large portfolio for these performance calculation numbers. And so here's our all-cap balanced portfolio. Like I said, this owns some stocks and bonds, cash in the portfolio over time, various levels at times. And $100,000 invested in this balanced portfolio, value portfolio, grew over the last 14 years to $259,000. $100,000 invested in the S&P 500 had grown to $164,000. So to give you the numbers, the cumulative return for the balanced portfolio is 159% cumulative. That's about a 7% annualized return, where the S&P was up 64% cumulative, a 3.6% return. And a blend, a 60-40 blend of stocks to bonds over that time was about a 17% return, or under 8.8, under 1%, 0.8% on an annualized basis. So we had very strong performance, very competitive performance over that time frame. And then, go ahead.
Can you go back to that for a second, Brian? I just want to make sure that I think what you said in your disclosures is this is after fees. Is that true?
Yes, that's after fees, expenses, commission, trading. Yes.
So the thing and one of the reasons for everybody here why I asked Brian to do this is here's a balanced portfolio, and if you were to be deluded into listening to CNBC over the last several years, it would have been real easy to think that bonds outperformed stocks over the last 10 years, right? Everything they talk about has been bonds, bonds, bonds. Equities only the last couple of years, but before that, for years, we heard about bonds. If you look at the last 10 years, that blended portfolio only did 0.8%. So clearly, bonds underperformed the S&P. So one thing is, here's a balanced portfolio, and this is what was interesting to me by focusing on the equities in detail. Even in a balanced portfolio with a heavy weighting of bonds or a potential heavy weighting of bonds, it was still possible to beat the benchmark. And I'm assuming you're using S&P because a lot of your clients think in S&P instead of in something like the ACWI or the MSCI, EFA, that kind of thing. Is that true?
That's true. Yeah, that's something that my customers really identify with and they understand, and that's why we use the S&P 500. And I just wanted to make a point, Matt, that the allocation to bonds in this portfolio fluctuated. There were times where it was very heavy, and there's times, and right now our allocation to bonds is fairly low, because we're not seeing the value there. We're value investors at heart, and at times, in the early 2000s, we felt like bonds were a much better value at that point. We're getting decent returns, at least getting some return on our money, where today you're just not, it's very difficult to get a decent return with fixed income without taking some, risks that we're not really ready to do. So.
Right, and I guess what I'm trying to highlight is the use of bonds from a value perspective. Like you're saying, sometimes it's great, sometimes it's not so great. This is very different than a FAMA or FAMA-based model or the efficient market model where you're going to rebalance every year to a 60-40 model. If you had rebalanced, you would have had very, very poor returns. By doing analysis and doing work, which is the kind of things that we talk about all the time, everybody, it's clear that you can beat whatever benchmark you want to beat. However, it's not going to happen by just doing blind rebalancing.
Yeah. So that's exactly how we think. We are not of the opinion that you just blindly own asset classes just because it's you don't want to be underweighted or overweighted a certain asset class. And we like to think the process through and think, okay, is there value there in this asset class? Is there value in this stock? Is there value in this bond? Or is there value in this sector of bonds or sector of industry or something like that? So we're constantly looking for value where we think the prices are not there's inefficiencies in the prices, short-term inefficiencies. So our next portfolio is just our stock portfolio. Like I said, it does have some cash in the portfolio. $100,000 invested in our stock value portfolio grew to $339,000 versus the S&P 164. That's a 239% cumulative. The S&P was up 64. It's a 9% annualized. S&P was up 3.6 on an annualized basis. And this is, like I said, largely customers that really had their objective was long-term growth using our value approach, and that's the customers that we have in this portfolio that represent these numbers, these returns. Any comments or questions, Matt, on that?
Yeah, one of the things that we talk about in our sessions, Brian, is if you are willing to do work, you can beat the benchmark. Here, if you're willing to do, and the reason that everybody that we've got Brian here is if you're willing to do lots of work, and you've noticed that even some of the things that he showed are things that we've seen before, people have talked about before. There are some tools to help do it, but doing the work, not just talking about doing the work, but actually doing the work is what's necessary. And then you can, obviously destroy your benchmark. However, it's not going to happen by thinking about it or hoping for it. It's going to happen from doing a bunch of work. So I just, we've talked about doing work before. We have some people that would love to have those kinds of returns but aren't willing to do the work. It's going to be hard. Either, and we've talked about this before, you either hire somebody to do the work for you or you do the work. Those are your only two options. The third alternative is not getting those results. So,
This is something I do, every day. This is something I enjoy doing. Sometimes I don't think it's work. It's something. It's just I enjoy doing it, and it's fun for me. I think it's my competitive nature, and it's something I am passionate. I really enjoy doing. I love the process of identifying great companies and trying to buy them below intrinsic value, and it's just I find a lot of fun and enjoy doing it. Just reiterate.
One quick question. All right, there was one other question on that, Brian. A lot of the people here are options investors. A lot are also options traders. Are you using any leverage in this, whether it's options or margin?
We're not. These are unleveraged. Without it, we're not doing any. We haven't been doing any option trading in these portfolios.
Are you interested in options, or is this back to your circle?
No, I've done quite a few option trades in my career. I spent 10 years of my first 10 years of my career as a broker, and I had several customers that were, option traders. So I understand options and I understand their value. I've chosen to spend my time identifying value companies, but I'm definitely, I like the idea of what options can do in a portfolio, help provide added income, reduce volatility, portfolio protection. These are things that I think can add value to a portfolio. But it's not something that we've done historically.
Great. All right.
So I think we've covered these disclosures. I think the biggest one is just, of course, there's just the risk of loss in trading securities. And, of course, none of the stocks we've talked about today is a recommendation to buy or sell a security. And the returns that we've talked about include the reinvestment of dividends, capital gains, and coupon income, and also investment advisory fees. And, of course, these figures represent past performance, do not guarantee future results. If you have questions, you can email me. There's my contact information. Call me, email me, and we're happy to talk to you more about these results, these portfolios, and our methodology.
Okay. A couple other questions came in, Brian. One is you mentioned the word very quickly that there was some cash. Are you keeping cash, and since these are individual accounts that you're aggregating, what is the typical cash allocation?
I would say typical is 5 to 10%. It would be typical.
Okay, so that's for a lot of the people here. That's a pretty high investment percentage, and that that's a lot of people are trying to keep way under 10% in cash. So those results would have been higher if you hadn't had as much cash.
Yeah, and I'd say, some accounts were, I'm making a generalization. I had some accounts that we had less than that. I would say maybe closer to 5, but we have, I'd say a kind of target between 5 and 10, right around 5, and sometimes that builds up to around 10, and then we put more money back to work, or we put some of that money back in when it builds up a little bit through dividends and things like that.
No, that's
we don't
just
have
making sure that Yeah, I just wanted to be accurate that those were not just, those were the total returns of those portfolios.
Yeah, we don't try to hold 10% cash. That's not a rule. We do try to keep a little bit of cash, probably closer to 5, but it sometimes does build up a little bit more than that.
Great. This was wonderful, Brian. One of the things that I noticed as we were going through this is when I think through my, the people I've been reading and studying, it starts back with Philip Fisher and then Ben Graham and Sir John Templeton and then Warren Buffett and then Ken Fisher. They all talk about the same kinds of things, and it would be nice to put other names in there like Brian Hunsaker or Matt Haley, but I don't think either one of us are at the fame of Ben Graham yet. But
No.
it is nice to see that the concepts that Philip Fisher taught Ben Graham now 95 years ago are still working today.
Yeah, I mean, I have Philip Fisher's book, and obviously Ben Graham's, and all these guys. I've read all their books and learned from them. And great concepts, and Buffett really attributes his investing success to Philip Fisher and Benjamin Graham, and really gives a lot of credit to Philip Fisher, and of course his current investment partner, Charlie Munger, as well.
Yes.
About looking at quality companies, and that's what really Philip Fisher and Charlie Munger really did to help kind of get Buffett looking for quality, as opposed to, he called them cigar butts, one puff and you're done, kind of companies. And looking at quality is really what Buffett kind of changed his strategy and evolved over the years to looking at quality companies that were growing and buying those companies at discounts. And yeah, learning.
I think the other thing that Munger did that's very wise that we can all learn from is, instead of trying to invent a new method, steal great ideas that have worked in the past and then just keep using them. And this is, value investing is clearly a historically working solution, and no reason to invent a new one.
Yeah, that's definitely me. I've learned. I've been trying to learn from other people who have had huge success, obviously, and not trying to invent the wheel. So, exactly, I appreciate all those that have gone before and really taught us and taught me how to be better at what I do.
Okay. I don't want to make this into a sales call, Brian. I appreciate all of the methodology and how you go through things. There's a couple questions here, and you can feel free to answer them or not. It's up to you. Do you have, are these portfolios all huge? Do you have a minimum that's, $4 million? Do you have a minimum smaller than that? Or, what kind of portfolio sizes does it take to do these kind of returns?
Ideally, we like to see a minimum of about $250,000. We will take accounts less than that, $100,000 to $250,000. It's really hard for us to do our job appropriately with much money less than that. Diversification and buying good allocations to different companies where we want to build a position. But I'd say minimum of between $100,000 to $250,000 is kind of where we kind of put our minimums at.
All right. I think we've taken all of the questions that have come in. If I've missed any questions, if you can hang on for a second, Brian, if anybody's got any questions that I missed, first of all, I apologize, and second of all, if you could throw them back up there, we'll put them back to Brian.
I've been tracking the chat as well. I didn't see anything missed either.
Thank you, Evie. I appreciate that, because I'm not as good at chat as you. I wish I could figure out how to enlarge the font so that I could read it.
Well, I just want to thank everybody for listening and the time you spent today, and hopefully it was valuable time, and maybe you got something out of it. So I appreciate the time, Matt and Evie and everybody.
Well, thank you very much for putting this together. I know that you normally are working one-on-one with people, not getting dragged into doing presentations to people that aren't your clients. So I really appreciate your time, and I hope everybody saw that there was some work involved. However, the hardest work there, if you noticed, was long division with a calculator or Excel. So this isn't advanced theoretical applied mathematics here. This was doing the work that we all know how to do.
Yeah, nothing, it's not rocket science. We're not all engineers like you, Matt.
And the world is a better place because of that.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.